Market rallies to no man's land. What happens next? Today on 3 Minutes of Markets and Money. Last week, the market rallied as expected, coming off these very deep oversold levels that we were talking about. Of course, the market turning up on a money flow buy signal, beginning to retrace that oversold condition. Markets did rally back here to the 50-day moving average. Now, that was actually that recovery rally that we were talking about, and the one to use to rebalance risk in portfolios. Now, we're currently at the position where the market has pulled back, broke back through the 20-day moving average, and is really sitting at this kind of no man's land, going back to these lows from December. The question now is, what happens next? Does the market break down and retest these October lows and potentially go lower, establishing a new bear market trend in the markets? Or do we find some support where we are right now and begin to rally higher moving into the March Fed meeting? That's the big question. The problem is now for investors is trying to figure out what happens next and how to manage portfolios. The problem of making a real decision here is the likelihood you could be wrong. If you make a decision this market is in a bear market, raise a lot of cash, sell off a lot of your risk in the portfolio, short the markets, you'll potentially be on the wrong side of the trade if this market begins to run up. Now you're trying to undo those transactions to get back into the markets precisely at the time that the markets are going to be retesting previous highs. So that may not work out well. The other side of this is that you get very bullish here, expecting a retest of these highs, and these markets break down and do go lower. Now the problem is you've compounded the risk in your portfolio. Given the problem of being in no man's land, the best course of action right now to take is to watch the support level that's going back to these December lows and begin to just rebalance risk in your portfolios. Again, not making any dramatic changes, but looking for things that have grossly underperformed during this recent decline. If you've had assets that have gone down more than the markets, think about reducing that risk, removing those assets out of the portfolio. If you've had things performing well in the portfolio, like energy stocks, that's great. But if they were 2% of your portfolio when you bought them and they're now 3%, trim those back to 2%. Again, don't remove your winners, but just trim back, take some profits, hold that cash. One of the mistakes that investors make is they think that if they sell something, they've immediately got to buy something else. That is absolutely not the case. Just raise a little bit of cash here until we can figure out what this market's going to do next. If the market then begins to accelerate back to the upside and we get, most importantly, above this 50-day moving average, that's going to suggest, hey, let's put some of that cash back to work, find some undervalued assets that have been starting to perform better, and allow the portfolio to grow. And if we do break out to new highs, then of course we're back into the bull trend, we're confirmed, and you can add more exposure to your portfolio at that time. If the markets begin to break down, you'll appreciate having that extra cash because it'll help hedge your portfolio, and then you can begin reducing more risk in your portfolio as the market begins a deeper decline. Again, these are small changes. You win this game by hitting singles, not trying to hit home runs on a regular basis. The biggest mistake investors make is trying to make big moves in anticipation of what they think is going to happen, but rarely turns out to be the case. Most time, investor guess right ratios are extremely low. So again, trying to predict what markets are going to do is very dangerous for your portfolio allocation overall. Make small changes, let the market tell you what it wants to do, and then continue to react quickly to changes in the market environment as they come. The biggest risk to the markets over the next month or two is going to be the Fed. Watch what's happening with markets as markets try to predict what the Fed's going to do. If the Fed becomes much more aggressive, particularly following that employment report on Monday, we could see markets come under a bit more pressure. But again, too much risk at this moment making a full-on bet as to which direction the market's going to go. Small bets, small moves is the right way to go in this environment. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. Be back here tomorrow.